If I was to start trading from scratch all over again, this is how I would do it. I'm going to show you that today on the charts. Hey, I've been doing this for 30 years. It's not something that I would want to do all over again since I've got all that experience, but I'm going to show you what I would do if I was to start today. Hey, it's Coffee with Rob. Let's have some coffee and let's get started. First thing I'm going to do today is quickly take you down the charts, and I'm going to show you a price action system that you can use that'll work for you, that'll give you a high probability trade on most occasions. And then I'm going to show you the strategy that's actually going to give you a business plan that's actually going to make you some money in the markets, because it's not the squiggly lines that makes you money, because trading is a 50-50 game and win rates are not what make you money. What makes you money is a good business plan, having a good plan to start with, and a good strategy. There's a difference between system strategy, a rather big difference, and I'm gonna take you and show you that in a little bit of detail after we've shown you the system on the charts. If you're interested in funded trading, there is a link in the description. If you want a free Forex book, drop down there and get that for yourself as well. Don't forget to join as a member so you can get the trade of the day every day and support the channel a little bit for future reference. But guys, without further ado, let's go to the charts, let's go and have a look at the system, and then we can talk a little bit about strategy and the way we trade in the markets. Let's go for it, guys. Now I will simply show you the system that's going to give you a high probability trade. And then after we've shown you the system on the charts, then I'm going to give you the psychology behind it, the strategy that's going to make you the money in the markets. Now, if I was to start trading today, I wouldn't use all these fancy fandangled indicators and complicated systems, but I'd keep it simple. Keep it as simple as you possibly can. Don't get overcomplicated with everything. The easiest way to do it, draw a resistance in, draw a support in. When the red candle comes out of a failed resistance, take a short. And when a green candle comes out of a failed support, take a long. If it breaks through the resistance and goes to the upside with a nice green candle, take a long. These are the easy ways to trade. These are the less complicated ways to trade. And then, of course, another fine way to trade is to take a trend line. There's a trend resistance. Draw it down. It's going to change the color to make it a little bit easier for us there, make it yellow. And why do I use a line chart to draw lines in? The main reason I use a line chart to draw lines in is because it's closing prices, not highs and lows. But I do like to use the candles to trade because they tell me when it's red, it's going down. When it's green, it's going up. I can see the tails. I can see the sellers and buyers getting back in. I can see when it's indecision. I can see when the market's ending. Candles give me a lot of information. But when I want to draw a line in, I'll rather draw it in on a line chart because that gives me closing prices. But now what I've done here is I've drawn in a trend resistance on the actual 4 hour that we're trading. I like to trade on the 4 hour because trading on the 5 minute, 99% of people lose. And the higher you go with your time frame, H4, day chart, weekly, the more reliable your information becomes. Which is why when we take these resistance and support levels, we take them from the daily levels. So what you've got here, you've got your trend resistance in. Now what you do is when this breaks through that trend resistance and gives you a green candle to the upside, that becomes a long trade. So where's a good example of this? A good example of this is Brent crude oil here. It breaks through this resistance, and this is now a long trade to the upside. So now you trade it long with a view to it going up in this area. What you do is you draw another trend over here, and if it breaks through that side, then you know it's broken to the downside. So which one was I using? I was using this Euro Japanese yen as an example. So what I'm going to do is going to show you that if you had, for example, had a trade here, you would have had a trade at this exact point. What you would have done is at this point here, the red candle would have broken through the trend support. The support would have failed. You had a red candle, you would have gone short. You would have got the short all the way down to here. If it comes up and breaks through that resistance and the resistance fails, then you're going to go long and it's going to go the other way. That's as simple as your trend trading gets. Or you can trade it every single time it comes off there, goes down, you can keep on going short and follow the trend. So if you're trading with the trend, as it comes down, every time it comes back, touches the resistance, you get a red candle, you go short, get a red candle, you go short, get a red candle, go short. That's trading with the trend. There's three ways we trade. We trade with the trend, we trade in this range, which is between the two, and we counter trade. The counter trading is when it breaks these lines. Trading with the trend when it stays within this trend line, and trading in the ranges off the resistance and off the support. Now, this resistance and support is also effective on the actual trends. How do I put this resistance and support in? Quite easy. I take it to a line chart. Now you've got a line chart. You take it to the day chart because you want to draw this in on the day. Then you just take a rectangle and you draw it. Why do I take a rectangle and not a line? You can draw a line when it's a double top or a triple bottom or something like that. And that's for another video. But this is just, you're looking for an area where all the orders are. You're looking for an area where every time the price gets to this area, it comes down. Every time the price gets to this area, it comes down. Every time it gets to this area, it fails every time it gets to this area. Why does the price fail every time it gets to this area? Because there's a whole bunch of orders in here. This is not supply and demand. This is just a resistance. It means there's liquidity here that's pushing the price down every time. And it becomes like a magnet that every time the price gets there, it goes down because there's a whole bunch of people selling it off and selling it down. So there's money there. Then you look for the support as well, and you draw it in. And you draw it in as a rectangle because there's an area. It's not an exact point. It's not like, oh, it gets to that point and then it stops dead like a brick wall. This is a market where there's a whole bunch of traders putting orders in, lots of different orders. So what you do is you expect the orders to be within that area, within that range area. So when the price gets there, somewhere in that area, you know that the risk to reward to go long here is poor unless it breaks through that and goes to the upside. If it breaks through that and goes to the upside, then you've got a really good trader. Come back, retest, and carry on going. So what you're looking for is to draw your resistance in, and you draw your support in. And you give it, there's a low, there's a low, there's a low. So in that area, there's your support. In that area, there's your resistance. This is reliable information because it's on the day chart. You can also draw your trends in here if you want to. You can look for a trend. So let's take that one out. We're not going to use that one on the day chart and say, you know what, there's actually a trend right there. That trend is telling me that that is where the price keeps on bouncing. You see it bounces off. If it bounces off that 3 times, that's a reasonably good trend area. So in other words, higher high, higher high, higher high. It's moving to the upside. That trend just tells you where it's going. We draw that as a line chart because it's just an indication of the trend of the price. There's also a downward sort of signal there. So it's going into a sort of triangle scenario. But what we're looking for is this uptrend and where it is. Then it's simple. Then you just take it back to the candles, and then you just take it back to the 4-hour chart that you're trading on. If you're trading on an hour, take it back to the hour. The reason we're putting this on the day chart is to get more reliable information. If you're trading on lower time frames, that's fine. Just remember, on the lower time frames, your information is not as reliable. Think of it this way. If I put 5 traders in a room to trade the same system, to test the system, 3 out of the 5 win. I've got quite a good win rate. That looks really good. I mean, that looks like a good system. But if we do the same test with 100 traders, you might find that 80 fail and 20 win because you've got a bigger test amount. You've got a more liquid test, and you can see how many people will win or lose with a bigger amount of people, a better amount of result. You get a better result from more quantity. So in this event, you look at this and you say, right, what have we got here? There's your trend support. It's broken through the trend support, so it could carry on going short right down to this support level here. But it looked like it wanted to turn around and go up, but it's come back, retested, and it's going down again. There's a good chance that this is going to continue on to the downside and continue on short. And what you use this for, if it bounces off that and goes up, then you would have known that this is going long again. This looks like it's going to the short side again. Probably coming down to the support level here or going up to this resistance level up here. That's how you trade support and resistance. Now, my advice to you guys with high probability trading, with looking for trades like this, with whatever system you're using, is just remember, this is just a high probability trade. This is not what's going to make you the money. This is just going to give you a trade that might go in the direction that you expect it to go. It's not necessarily going to win you the money. The strategy that I'm going to show you now, after the charts, is what's going to make you the money at the end of the day. So now you've seen the system. Now you know what a system is. A system is basically the high probability trade that you need to kind of get ahead in the market. You have been on a course that you've paid thousands of dollars for, and that course would have given you a system. It might not be the same as this system, might be a completely different system, but what they would have taught you is that that system will make you money. What they would have taught you is that a win rate will make you profitable. And what they would have taught you is that you have to follow that system to the T. What they didn't tell you is it's not the system that makes you money, it's you. It's the psychology in your head. You see, every human being ever known to mankind is developed with some kind of fear receptor in their brain, some kind of fear level. There's a breaking point. There's a point that you can't handle anymore. There are those that can take more than others. But for example, if you start trading with real money, for some people, even if you're trading with $1, you start sweating immediately when it starts to lose. For others, it might be $100. For others, it might be $1,000. But everybody's got that limit where they can't sleep at night. And that is what causes you to lose in the trading markets. The fear that overcomes you when you're trading, whether you're in a profit or whether you're in a loss, it's always going to get you. And the other thing that's going to get you is FOMO, which is the fear of missing out, not being able to be patient, not being able to sit on your hands, and wanting to constantly overtrade. It's just one of those things in the market that's going to affect your trading immensely. But I'm going to give you a strategy that's going to help you to become profitable in the markets, and it's going to help you to get around that psychology which is holding you back. Now, you may have heard me say before the charts that trading is a 50-50 game. And I get a lot of flack for that. But before we go into the strategy, I need to explain this to you. And the reason I need to explain this to you is because if I go to the strategy without explaining this to you, you might not quite get it. First, you have to get the picture in your mind of what you're dealing with. Because all of you are sitting there looking at little charts and thinking, I'm going to make money off these little charts and these little squiggly lines and these candles and all these little indicators and systems that the guys gave me and told me are going to make me money. Not realizing that the market is more subjective than you think. Because what you've been taught, or what you think you've been taught, is that the market's made up of algorithms and mathematical equations, and it's all about maths and it's all about lines. Which means if a price hits a specific point and a specific line, because of some maths algorithm, it's going to bounce off that and go back the other way. Some magic reason, some kind of magic maths formula that's causing all this to happen, isn't it? No, there isn't. Here's the thing. What you have to understand is behind all those squiggly lines, and the reason you have those squiggly lines is behind all those squiggly lines are traders. The market is made up 100% of traders. In other words, there's people behind those lines. And the whole reason you're following those lines for a high probability trade is because human beings are creatures of habit. So what's happened in the past will in all likelihood happen again in the future. See where I'm going with this? That's what those lines are. So whatever those lines are doing, whatever those candles are doing, are effectively what human beings are doing. So what you're searching out in those charts effectively is liquidity. You're looking for where people have left their orders. You're looking for areas where the masses are going to go and buy or sell so that you can get on the bandwagon and do the same thing and go with those people. Now, if you think you've got a system that's now going to give you a 7 out of 10 win rate, and it's now somehow going to make you profitable, and let me go into detail with the win rate as well. Win rates don't make you profitable. They just give you something to boast about. Because if you win 7 out of 10 trades, and you only win $10 on the 7, and you lose $1,000 on the other 3, you're kind of in a loss, even though you've got a 7 out of 10 win rate. Win rates don't make you profitable. Psychology and the strategy of how you approach trading, that's what makes you profitable at the end of the day. So why is the market a 50-50 game? Think about this, guys. Every single trader in the market wants to win. Nobody wants to lose. So you think you've got a system that's now got a 7 out of 10 win rate that's now going to beat all those other traders. With the knowledge, by the way, that 60 to 80% of traders lose money. So let's average that out at 70% of traders lose money. So we're thinking here that basically you think you're part of the 30% that are going to win. You're brand new to trading. but you're part of the 30% that's going to win. There's no way you can be part of the 70% that's going to lose, because I don't know any traders who would believe that. I don't know any traders who think they're going to lose in the markets. Otherwise, they wouldn't be trading in the markets, would they? They'd be doing something else. Trading is risky. And if you don't like risk and losing money, you shouldn't be trading. Simple, really. If you're day trading, 99% of traders lose money there. But you'll tell me I won't be part of that 99%. I'm part of the 1% that's going to win, because I want to day trade, because I'm a day trader. This is the problem that we have in our mentality. We don't understand that we could possibly lose. We can't put it together in our minds that we could possibly lose. We believe every single time we take a trade, we believe we're going to win, which is natural. Otherwise, why would you take the trade? You're not taking the trade because you want to lose. You're taking the trade because you believe that you're going to win that trade. That's the only reason you would take that trade. The psychology behind it is this. If you want to get around all these problems, you want to get around all these issues, you want to get around all these win rate issues and 50-50 issues, because the whole point of 50-50 is if I toss a coin 10 times, the high probability is that you're going to lose 5 times and you're going to win 5 times. That's the high probability of a coin toss. Now, you're going to tell me the market's not a coin toss, but effectively, that's the way of the world. It's a coin toss. No matter what your system, no matter what your strategy, it's still a coin toss. The point of this is to lose less on your losses and make more on your wins. In other words, the 2-to-1 ratio, yes, and you're going to say, I've heard all this before. No, you haven't, actually. What you've heard is people tell you need to make 2-to-1, but they haven't told you how to do it properly, and they haven't told you how this works. Because you've got into trading with no plan, and you just, I'll make more on my wins and lose less on my, I'll just make any old amount, and I'll just take, on this trade, I'll take a $50 stop loss. On that trade, I'll take $1,000 stop loss. On that trade, I'll take 5. And they're all a mishmash of trades. And then you look and you're wondering why you're in a loss. That's because there's no control. It's because there's no plan. It's because you don't really know what your profit margins and losses are. You've got no idea. This is the basis of the psychology behind our plan. The strategy is this, guys. You've got to take your account size. And I'm going to say your account size is $100,000. Because I get this question all the time. Can I make a living out of trading? Sure you can. You can also go bankrupt trading, but you can make a living out of trading, but you need a decent size account. You can't do it with $15 or $10 or $100. These guys that tell you can make $1 million at $100, it's a bit of a joke, really. You're going to struggle to make money in the stock market, let me tell you. This is not an easy game. This is not something you learn in a week. Sure, you learn to become an electrician in a week, eh? This is a game that you have to learn, that you have to get your head around. So let's say you've got a $100,000 account. I'm just using that as an example because it's easy to work the percentages off. What I do is I use a 1% risk on every single trade on the size of the account. If the account goes down in size, don't change that. If the account goes up in size, don't change that. In fact, if the account goes up in size, take your profits out and put it in the bank, because that's where it's supposed to be. So your account's $100,000. So now what you do is you say, I'm going to risk $1,000 on every single trade that I take. In other words, 1% of the 100,000. You can risk any amount you want. You want to risk 10%, if you're comfortable with that, good. If you want to risk 5%, you're comfortable with that, good. If you want to risk 1%, like we're talking about here, comfortable with that, good. If you want to risk 0.5%, that's also good. Just decide what your risk is going to be on every single trade. You can review it every couple of months and say, well, I feel like changing it to this now. I'm more comfortable with that now. That's up to you. Keep it the same while you're in a run of trades. Now you've decided on a 1% risk. So every trade is 1%, $1,000 per trade. Do not change the risk amount when you go to another trade. Don't say, oh, I'm more comfortable with that kind of instrument, so I'm going to risk a little bit more there, because then the system can't work, can it? Because you're going to lose more or less on that trade, which is really not going to help you at all. It's just going to put you back where you were. Keep the risk the same on every single trade. But now how do you work that risk out? Because you're going to say to me, yeah, and I got the stop loss here and a stop loss there. And guys, first thing you do is if you see a trade that you like, look at the trade, decide where you want to put your stop loss. Before anything, decide where you want to put your stop loss. I call it an invalidation area. An area when I look at the trade and I say if the price was to reach that area, this trade would be invalid. I wouldn't want to be in that trade. That's my stop loss area. Then I work out how much is $1,000 back from that area to where I'm going to have to pay the cost. How many lots can I get? How many contracts? Is it 0.4? Is it 2? Is it 1? How many pips? Whatever the case. That's the size of my trade. Now I've worked out the size of my trade back to the cost. Can I make 2-to-1 out of it? You don't just put a price of 2-to-1 out there and say, well, there you go, just willy-nilly, I'll just make 2-to-1. No, if you're going to make 2-to-1, It's got to be an achievable target. You've got to look at it and say, if I put my take profit there, is my risk to reward good? Am I going to make more than I'm going to lose? I don't want to win $50 and lose $1,000. I want to make $2,000 and lose $1,000, but it's got to be an achievable target. So you've got to look at the trade and say, is the risk to reward there? Is it worth my while taking this trade? Because if it's not, then why are you taking it? Don't bother. If you can only make $50 on the trade, leave it. Go find another trade, man. You don't have to trade it. So now you've worked out what your profit's going to be. You put that in, put your stop loss in, put your take profit in, take the trade. There you've got it. Now it goes into loss. And the first rule is don't dollar cost average down, because what's the point? You're going into loss. If it reaches your stop loss and it's going down, don't move your stop loss away, because what did you do in the beginning? You said it's an invalidation area. You looked at that area and said, I wouldn't want to be in the trade if it reached that price. But for some other unknown psychological reason, you'll move the stop loss away. You said in the beginning it's an invalidation area. You actually said, I don't want to be in that trade if it gets to that price. Why are you moving the stop loss away? Let it go, walk away, next trade. Learn to lose. Learn to take that loss. If it goes into profit, that's even worse, because it goes to $300 profit. You're sitting there and you're looking at the trade. You're getting itchy fingers, aren't you? You want to take the profit. You're like ready to click the button and take the profit. It's in profit. You want to take it. And you're going to turn around to me and say, but bro, a profit's a profit, man. It's a profit. No, you want a bigger profit than that. Otherwise, you're going to take a couple of $1,000 losses. And now you're going to take a couple of $300 profits. It's not going to work for you. You're not going to make the money there. You've got to learn to sit in your hands or take a brick and smash your fingers in or something so you can make better profits, bigger profits. The trick is when it goes into profit, you're going to move your stop loss up to break even. And when it goes further into profit, you're going to move your stop loss up behind it. And there'll be a whole mishmash of trades where the stop loss comes back or the price comes back and takes out those stop losses while you're in profit. And you're going to have a whole row of little profits. I could show you a statement now. There's a whole row of little profits. And it's annoying because you keep on taking those trades and you keep on moving your stop loss up and it keeps coming back, taking those stop losses out for smaller profits. It happens all the time. What you're waiting for is that big one. And when it goes all the way up to that $2,000, you just got to move your stop loss right up behind it and not take the profit. Because if it goes through that and carries on going, you're going to keep following it with your stop loss and you could make much more money. There's much more money maybe on the table. That's how you trade it. That's how you follow it. That's the strategy. Now, can you tell the difference between a system and the strategy? The system gives you the high probability trade. And no matter what the system is, it's 50-50. And there's a good chance you're going to lose more trades than you win. The strategy is to make money. Strategy is a business plan. The strategy is a way for you to manage your risk and manage your profits so that you can actually be profitable on any trade, on any system, no matter what. Hope that helps you guys. Don't forget to go and watch the last videos. Come back and watch the live show tomorrow. Thanks for watching, guys. Till the next one. Cheers, ciao, and bye.